Good morning, Chris.
James, good morning. Thank you very much indeed for having me on. Very kindly.
Well, yeah, indeed, we're quite keen to hear how CG's been doing. So I'm going to hand over to you and let you talk about the fund for a bit, and then we'll ask some questions if that's okay.
Okay, fantastic. And if you're driving, yes, let's. Should we do we need to do the legally disclaimery bit, or do we think that's been covered off?
You don't need to read that out, but everybody can read it in their own leisure. They can go back and pause the video.
All right, excellent. Okay, so thanks very much for having me. CG Asset Management. So we were founded in 2001. We are a small boutique fund management firm based in London. We run 3.3 billion pounds. And the money that we run is divided up into two strategies. We run conservative multi-asset absolute return funds on the one hand, and then we run index-linked bond funds on the other. And our conservative multi-asset funds are designed, in theory, to look after all of the money of a private investor who is of a risk-averse nature. Or alternatively, they're designed to provide ballast to the portfolio of a more adventurous investor. Next slide, please. So Capital Gearing Trust is our flagship multi-asset fund. And our founder, Peter Spiller, has been running that since 1982, which makes him the longest running fund manager in London, I believe. And if you had been lucky enough or smart enough to have invested when he took it over in April 1982 and invested £10,000, you would have £2.6 million today. But perhaps the thing that we're most proud of and the thing that we spend a lot of time thinking about is avoiding losing money. And so over that period, there have only been 2 down years alongside getting that return of 262 times your money. Next slide, please. So that's one half of our business, doing multi-asset investing. The other thing that we do is run index-linked bond funds. And so those are bonds where the interest and the principal are indexed to inflation. And this forms a large part of our multi-asset funds, but we also do it on a standalone basis because it's an area that we have some expertise. And I show here on this chart the performance of our UK holdings. And so we run 3 funds. One invests exclusively in UK index-linked bonds, which we launched in October last year. One that invests in US government inflation-linked bonds that are known as TIPS. And then the third one invests in a global portfolio of index-linked bonds outside of the UK. And I show here, this is the performance of our holdings of UK index-linked bonds, actually in our multi-asset funds going back 5 years. And as I'm sure you and all of your viewers are aware, a lot of people have had a pretty torrid time investing in UK index-linked bonds. And you can see that the peak to trough fall from the index, which is represented by the dark line on your screen, is about 50%. Now, our holdings, conversely, is the pink line. And those, you can see, cumulatively have outperformed the index over that period, again, by around 50%. Now, I'm not pretending for a second that we're going to outperform it in that kind of way in the future. But hopefully what it does demonstrate is that our approach is to take much, much less risk in our index-linked bond holdings and try to generate modest, positive, real returns. By that I mean, positive returns after the effect of inflation. But enough about our index-linked bonds. Mostly what I want to talk about today is Capital Gearing Trust, because this is a show about investment trusts. This is so what are we trying to do in Capital Gearing Trust? We are trying to avoid losing money over a 12-month period, and then we're trying to grow shareholders' wealth over time. How do we do that? We do it in a fairly simple way. We're not trying to be too clever. So we invest in a mixture of cash, bonds, index-linked bonds, and equities. And so we think about asset allocation in terms of 3 main buckets. The first bucket we call dry powder. And dry powder is made up of cash, treasury bills, and short-dated, high-quality corporate bonds, predominantly in sterling. Our second bucket is index-linked bonds. And the purpose of this bucket is to provide portfolio protection. And so we expect this part of the portfolio to do well when equity markets fall, whether that's because equity markets are falling in response to a recession or perhaps some kind of financial panic or crash. Now, why do we choose index-linked bonds over nominal bonds to provide this function in the portfolio? Well, there's two main reasons. The first is that we believe that the era of low inflation that we've been in for, call it since the turn of the century, has come to an end. And we expect structurally higher inflation in the future. So we expect index-linked bonds to outperform nominal bonds. That's the first reason. The second is that equities and bonds have been negatively correlated with one another for most of the past 40 years. So that says that, when your equities go down, your bonds go up, and perhaps vice versa. And that's how, by blending them together, you can build a satisfactory balanced portfolio that performs pretty well in most environments. However, there's one time when that negative correlation breaks down, and that is during periods of high inflation. And that's because those conventional bonds tend to perform pretty poorly in periods of high inflation. And, we saw that in 2022. So that's why we think that index-linked bonds serve the job of portfolio protection much better than conventional bonds in our portfolio. And then the final chunk of the portfolio is what we call risk assets, and that means equities. Now, we aren't stock pickers, and so we buy equities by investing in the investment trust market itself, and we buy investment trusts that are trading on discounts where we think that discount is likely to close. And that's something that we've been doing for over 40 years, and we have a long track record of being successful in. So, as the chart says, we've got 19% of the portfolio in dry powder, 46 in index-linked bonds, and 35 in risk assets as things stand today. Now, as it happens, a number of those index-linked bonds are pretty short-dated and very close to being cash. So, for all practical purposes, you can think about the portfolio as being a third in dry powder, a third in index-linked bonds, and a third in risk assets. So let's look at each of those buckets in a tiny bit more detail. In truth, there's not a lot to say about the dry powder bucket. That's yielding a little over 5% today. And it's really there to provide optionality. That can be deployed into either index-linked bonds or into equities when opportunities present themselves. Turning to the index-linked bond part of the portfolio, the largest chunk of that is in US inflation-linked bonds, TIPS. So that's 20% of the overall portfolio. And there you're getting a return of about 2.2% real. So that's 2.2% after the effect of inflation. And we've got about 14% of the portfolio here in the UK, where the returns are a little bit less, but obviously you're not taking any currency risk. And then the balance is in a smattering of high-quality jurisdictions, so Sweden, Canada, and Japan. And then turning to the risk assets, a little over a third of the portfolio, 19% of that is in conventional equities, and as I said, nearly all of that is in investment trusts, and 12% is in alternatives. And the vast bulk of those alternatives, 8% of that 12%, is in infrastructure. And I'll touch on why we're attracted to that in just a second. On the right, you can see, although I think I might be blocking, the picture of me might be blocking the key piece of information on the right of the slide, you can see the performance over the last 12 months. And that is 5.2% NAV total return. And that's, we've had, in truth, a somewhat muted period of performance. That is, a little over 5% is not too bad. Our NAV total return since 2000, which is sort of, a longer time horizon, but not going all the way back to the beginning, it's been about 8.3% per annum. And you can see that each of our asset allocation buckets have contributed positively over that period. Next slide, please. And so on this chart, we break apart the performance of our equities on the one hand and our bonds on the other. And it goes back to 2015, which is when we put the software in place to be able to do this kind of analysis. We compare our performance of our equities to the investment trust market because that's what we chiefly invest in. And you can see that the cumulative outperformance since then has been about 30%. And then on the right, you can see the performance of our bonds. And there we compare that to sterling aggregate, which is a sort of broad-based index of sterling-denominated bonds. And there the cumulative outperformance has been about 45%. So hopefully that shows that the two main buckets of the portfolio have been performing reasonably well. Next slide, please. So I mentioned that we like investing in investment trusts on discounts. Well, what are we up to in that area? Discounts in investment trusts are as attractive, as exciting as they have been since the GFC. So there is plenty of opportunities for us to pick through at present. And I just share a couple here on the chart. So on the left, you've got Smithson Investment Trust. Smithson is in the Fund Smith stable, and it invests in a global portfolio of mid-cap stocks that meet the kind of Terry Smith criteria of quality and growth. And the fund has outperformed its benchmark by about 50 basis points since it IPO'd, so that's 50 basis points annualized since it IPO'd. But it had a bit of a tough time in 2022 and now stands on around a 12% discount. So we've built a fairly large position in the trust. And crucially, on top of it being run by a manager that we hold in high regard and think is going to do a good job, we think that the board are trying to do the right thing. So they've bought back £200 million worth of stock over the past 12 months. And we believe that they're committed to bringing the discount much lower. On the right, you have Finsbury Growth and Income, which I'm sure I don't need to introduce. It's a trust run by Nick Train with a fantastic long-term track record. But it is worth dwelling on that track record. So he took it over in December 2000. Since then, the NAV total return has been 640%, plays 243 for his reference index, which is the UK market. Now, this promises a discount of 5%, and it's currently trading on about a 9%. The board, again, are taking steps to address this. They've bought back 10% of the company just since the start of the year. So we think that they will get that back under control. So those are a couple of examples of equity investment trusts that are exciting us. Next slide, please, James. And this is, I mentioned that we have 8% of the portfolio in infrastructure, and I'll show you a couple of names here that we're really excited about. On the left, we have IMPP. IMPP owns a range of infrastructure in the UK and abroad. So it owns most of the UK gas network. It owns a large number of OFTOs, which are the power lines that transmit power from offshore wind farms to the main grid. And then on the right, you've got HICL. HICL owns a portfolio of PFI contracts. It owns toll roads. It owns HS1, which is the rail line that links London to the Channel Tunnel. And as you can see, both of these are trading on about 20% discounts to their net asset values. Now, obviously, whenever you've got a situation where a company is holding private assets, there's a risk that the stated NAVs aren't actually true. However, in the case of these two funds, we've got pretty high confidence that the NAVs are real. And that's because IMPP has sold £250 million worth of assets over the last 12 months. HICL sold about £500 million of assets. And in both instances, they sold those at or above the values that they had the assets in the books at. Indeed, actually, the last material asset that Hickel sold was a toll road in the US called Northwest Parkway, and they sold that at a 30% premium to what they had it in the books at. So what's really exciting to us is that at these discounts, these trusts offer prospective returns of about 9 to 10% per annum. And while there's nothing certain in this world, you can have a pretty high level of confidence about the underlying cash flows of these infrastructure companies because of the fact that the nature of the cash flows is long, contracted, and very often with a government or a similar creditworthy counterparty on the other side. And crucially, those returns of 9 to 10% per annum make no assumptions about the discount closing. So if the discount is closed, perhaps by the boards taking action and doing buybacks, and they are starting to buy back, then the returns could be much more exciting than that, but we're not assuming that. Next slide, please. So that's hopefully a little flavor about some of the equities that we have. And I just want to talk about the role that the bonds play in the portfolio. So as I mentioned, we think about these as offering portfolio protection. And that's because interest rates tend to fall either in recessions or in financial crises. And obviously, when interest rates fall, the price of bonds goes up. And so holding, and then in addition to which, if you hold longer dated bonds, you're subject to something called convexity. Now, convexity is just a fancy way of saying that when you have an equal and opposite move in interest rates, you make more money when interest rate falls than you lose when interest rates rise. And you can see a pretty good example of this here. I've actually, because the maths is a bit more intuitive, I've used just a 10-year conventional bond in the US. And you can see that if interest rates rise by 1%, 100 basis points, on a one-year basis, you'd lose about 3% of your money. Conversely, if interest rates fall by 100 basis points or 1%, the same amount, you make a little over 13%. So that's what we mean by convexity, what we mean by these offering kind of asymmetric returns and hopefully good portfolio protection. So that's kind of what that final portfolio protection bucket is meant to do. Next slide, please, James. I didn't want to talk about macroeconomics. I wanted to leave that open to your questions. We can bang on about it for days and days and days if you'll let us. But what I did want to do was just leave one thought with you, which we think is really, really fundamental. And this is this point that I made earlier on, that we think that the era of low inflation that's characterized the last 25 years has come to an end. And I just want to talk about why we think that is. And because of the fact that inflation is probably the single most dangerous thing to investors' wealth. And so, however you go about constructing your portfolios, you need to have inflation front and center of that, in our view. So what are the big themes that are going on? Well, the first is the unwind of globalization. Now, even if there weren't these geopolitical tensions that we've got, as between the West and China, which is causing this reshoring or nearshoring or friendshoring or whatever you want to call it. Even if that hadn't happened, the deflationary tailwind of globalization was always going to come to an end, because as wage rates in developing countries rose to meet those of Western economies, then that deflationary effect of globalization was going to come to an end. And so not only is that happening, but we're seeing the acceleration as not only is the deflation from globalization reducing, but actually it's getting unwound as manufacturing is brought back closer to home. The second thing is the energy transition. Essentially, if you think about what is happening in the energy transition, we're taking low cost, at least in economic terms, low cost production of electricity, and we are installing higher cost production in the form of renewables, and then on top of which we're going to be introducing carbon prices. Now, obviously, this is essential to the world, but it requires huge amounts of investment, which is going to put a pinch on resources, and we are replacing highly productive capacity with less productive capacity, for very good reasons, but it will be inflationary. The third thing is war and defense. War is the ultimate source of inflation, depressingly. And you only have to look at just the destruction of physical capital in Ukraine to see why that be the case. And then, of course, when hopefully the war is over, the rebuilding of Ukraine will consume yet more resources and be expensive. And finally, there's just the fact that when the global economy is oriented no longer on the lowest cost lines, and instead is along the lines of geopolitical alliances. By definition, that's inflationary, because cost is no longer the primary consideration of where you procure goods and services. And then finally, capital versus labor. A sort of a side effect of globalization over the last quarter of the century, perhaps going back further, has been that labor has earned an ever smaller percentage of GDP, and essentially because if labor kicked too hard, then capital would say, well, fine, we'll just close down the factory or whatever it is, and we'll move it to China. And so we are starting to see that labor is kicking against that. Labor feels that it has received the fuzzy end of the lollipop. And so, whether it's the United Auto Workers in the US or the junior doctors here in the UK, labor is going to be arguing for a bigger slice of the pie than they've had. Anyway, that is enough from me, James. I'll turn it back over to you and your listeners.
Thank you very much, Chris. That's great. Actually, let's stick with inflation for now. So we've had now a couple of months where UK inflation has been 2%, which is in line with target. Do you think that's now under control?
I certainly think that inflation, the kind of inflation that we saw around the Ukraine era, sort of 12, 14%, is not going to come back in a rush. But equally, when you look at the biggest component of inflation in an economy where services dominate, as is the case here in the UK, it's going to be wages. And I think we had the wage number just a couple of days ago, and I think that was 5.7%. And there's just no way that 5.7% wage growth is consistent with inflation remaining at target of 2% over the long term. So yes, we're having the nice effect of lower energy prices and the year-over-year effects of coming off some of those historic highs, particularly around food. And so I think that we'll see perhaps quite a number of low prints for a while. But I think the risk is that inflation settles down into sort of something more like the 3 to 4 kind of range rather than the 2 to 3 kind of range.
Okay, that's great. What do you think the impact of the new government here in the UK is going to have?
Wow, I mean, that's a great question. I think the first thing to say is that it's really encouraging to see that the new Labour government, has identified what the big challenges are facing the country. Essentially the growth has been pretty anemic, and in turn they've gone quite some way towards identifying, well, at least one of the big problems, which is around the planning regime, and they are having a crack at addressing that. So I think that all of that is very encouraging. Addressing growth, I mean, really, and when we say growth, it's really about productivity, because productivity is the thing that drives per capita growth, which is, of course, which in turn results in higher living standards, which is what we all want. And I suppose that if you think about what are the three things that drive productivity, well, I guess you would say that they were kind of physical capital. So that's kind of it's investment is the thing that drives productivity, and I guess you can think about it in three ways. One is physical capital, and that's kind of infrastructure, whether public or private, and the government seems to be very focused on that, and that's clearly a good thing. There are two other elements of capital. There is human capital, so that's around skills and education. Or alternatively, if you're in a rush, it's about getting immigrants to come to the country to fill our skills gaps. And then the third is around, I guess, what you call social capital. So that's around having efficient supply chains and the network effects that arise from having lots of companies, in a particular area close to one another. I think we've heard a lot about the first, about physical infrastructure and investment. We haven't heard very much about the next two. And all of these things are very difficult to do and take a long time. And of course, with a Labour government, I'm a little bit nervous that there'll be too much of an emphasis on kind of state intervention rather than kind of private initiative. But it is nice to see a government kind of clearly honing in on the problems and trying to address them.
Great. Okay. Let's talk a bit about index-linked bonds, I guess, for a minute. Let's go back. Let's do this one actually. So, how did you do it? I suppose is the question. How did you manage to outperform so dramatically?
Well, the reason is that, put bluntly, index-linked bonds were in a monumental bubble in 2020 and 2021. So just to give you an example, the longest inflation-linked bond in the UK is the 2073. That came to market in the autumn of 2021, and it came at a price of £356 per £100 of face value. So that meant, and it had a trivial coupon on it, so we can ignore that for our purposes. And so that meant that if you wanted to have £100 to spend in 2073, you needed to spend £356 today, or back in the autumn of 2021. That was just frankly an insane price, and there was almost no future that you could imagine where that investment would be a smart investment to make. And so, as ever, if you pay too high a price for an asset, you're going to do terribly. So the way that we avoided it was that we said, okay, these long-dated UK index-linked bonds are terrible value, and we're not going to own any of them. But we also believed at the time that inflation was likely to be very much higher than markets were expecting. So we bought short duration index-linked bonds, ones that were close to maturity. And really all we said was that, fine, we will earn the difference between what the market is expecting inflation to be and what we expect inflation to be. That's essentially what you're seeing on that pink line. And so, that's turned out not too badly for us.
So if we look at the portfolio now, what's the kind of duration balance on it now?
So our US tips have got a duration of about 9 years. So that's an average maturity of, call it, 2033. And that's reflective of the fact that with that kind of downside, with the portfolio protection, the asymmetric returns, we want to have some duration somewhere. And we do that in the markets where we see the biggest value. So because the yields are highest in the US, we're happy to lock those in for a longer period of time. Here in the UK, our duration is about 5 years. And that just reflects the fact that the values on offer aren't quite so appealing.
Oh, okay, thank you. do you gear the portfolio at all? Do you borrow money to enhance returns?
We don't, and so so the name of the trust, Capital Gearing Trust, is something of a misnomer. But we have not been geared since sometime in the early 1980s.
That all makes sense to me. Okay, that's okay, cool. So there are some similar trusts doing what you're doing. So how does capital gearing differentiate itself from the other ones?
So, the two trusts that we're most often compared to would be Personal Assets, which is run by the team at Troy, and Ruffer Investment Company, which is run by the team at Ruffer. And I think I'd say that, intellectually, we see the world through a very similar lens, and we are largely trying to achieve the same thing. How we go about doing it is a little bit different. So I think that if you look at Troy tends to have a focus on quality growth equities, typically in the US, and tends to have a much higher allocation to gold. We tend to have more of a focus on index-linked bonds and more of a focus on value. And of course, we've got our specialism of investing in investment trusts on discounts. And then Ruffer is more prepared to use derivatives to protect the portfolio. So they use credit derivatives and volatility derivatives and those sorts of things. I think that both of those investment trusts are incredibly high quality and run by very, very smart people. So perhaps you might say there was a case for owning all three of us.
Fair enough. Is it the sort of thing you'd buy if you're a sort of young investor and you're looking for the future?
I think it's a fair point that over very long periods of time, equities have been the highest performing asset class. But I think it's also true that there have been periods in history when equities have gone backwards in real terms for 30 or 40 years. And of course, what's incredibly difficult is you don't know when you're starting out whether you're one of those, you're going to be unlucky to have one of those periods ahead of you. So I think that there is always a case for owning assets other than equities in the portfolio of even quite young investors, but clearly you would be more inclined to tilt your portfolio more to equities if you're a young person who's saving for kind of 40, 50 years hence.
Fair enough. I mean, and actually, at what point would you tilt the portfolio much more into equities than it is now? What would be the trigger for doing that?
I think the trigger would be, essentially what we're trying to do is we're trying to assess what are the prospective returns from owning equities on the one hand, and what are the risks associated with them. And the main thing is that when we look at the US equity markets today, and of course, US equity markets, well over 60% of global equity markets these days, we think that the US looks very expensive. So the CAPE ratio is well into the 30s. It's only been more expensive twice in history, once in 2021 and the other time in 2000. Equally, if you look at just look at the PE ratio, it's I think sort of 15-20% above its long-term average. Analysts are forecasting more optimistic earnings growth for US equities than at pretty much any point in history other than around the tech bubble. So you put all of those things together and that makes us pretty nervous. On the other hand, it is true that a lot of the equities that we own, we've got quite a large overweight to the UK, to Japan, to these investment trusts, to this infrastructure, looks fantastically cheap to us. But of course, what we know is that when US equities fall, all other markets tend to fall with them by about the same amount. So essentially, until we could see US equities, something approaching fair value then we're likely to have a constrained overall exposure to equities.
That makes sense. How did the asset allocation shift around, say, over the last 5 years? So you think about sort of when we went into COVID-19 and the other side of that, what happened?
So yeah, I think that's a great example, because that was a sort of a fairly dramatic event which resulted in a pretty profound repricing. So in early 2019, our risk assets were in the low 20s%, and I forget exactly where they are, if I'm honest, but it would have been somewhere in the 20 to 25% range. And then post-COVID, our risk assets topped out in the high 40s. So at the moment, you can say that we're somewhere in the middle of that range, and generally you should expect that we're probably going to be somewhere between about 20 and 50%. On most of the time, and so our asset allocation tends to move pretty slowly, and that's because in reality the long-term prospective returns also tend to change pretty slowly, but we do occasionally move quite quickly, and an example would be for the kind of 6 months post-COVID would be one time.
And there's a bit of gold in there. Is that real gold, or is that an ETF or something?
It is an ETF, but it is physically backed and vaulted in Switzerland.
And what's the thinking on that? Because it's not a huge position.
It isn't a huge position, and really, it's there to remind us to think about gold. And our view. The problem with gold, of course, is that we have no idea how to value it. And just as I was saying that if you pay too high price for an index-linked bond, you can have a horrible result. Well, the same is true for gold. So if you bought gold at its peak, which I think was March 1980, you suffered a greater than 80% loss in real value from there to the trough in 1999, which more or less coincided with Gordon Brown selling all of the gold in the Bank of England. But whereas I'm able to explain why buying those 2073 index-linked bonds was a terrible idea, it's much harder to explain why it was a bad idea to own gold in from March 1980 to 1999. So we think that index-linked bonds offer similar protection to gold against the kind of things that you might be worrying about if you're buying gold, but it's much easier to explain why you own it.
In terms of kind of the equity portfolio, so you explained some of these. You can get some ratio trusts and wider discounts. Is there always a kind of quality screen that these things need to go past before they go in the portfolio?
I think I'd put it another way, James, which is that everything has a price, right? And so a very small illiquid trust in very niche assets, if it's on a sufficiently large discount, then we'd look at it. But I think that what's exciting us at the moment is that you can buy banner name investment trusts that are large, liquid, and run by really high quality managers on, okay, fine, maybe not the highest discounts in the sector, but very attractive discounts based on pretty any much view of history. And so that's where we are focusing our attention at the moment.
Fair enough. That all makes sense, actually. So good luck with it all, really.
Thank you very much indeed.
I think we shall wrap up there, and there's another disclaimer for everybody to look at, and we'll get you back again in a year or so and see how it's been going. But thank you very much for your time this morning, Chris. Thanks. So we will be back next week.
I really look forward to it.
Cool, thank you. We'll be back next week talking, and Rich will be talking to AEW UK REIT. And then we've been saying for a while, we've got a full kind of lineup all the way through the summer and out the other end. So please do still let us know if there's something you'd like to hear about and we haven't got it on our list. But in the meantime, have a good weekend, and we'll see you next Friday.
Thanks very much, James. Bye-bye.